we've been concerned about inflation for quite some time. And remember now, the numbers that came out today exclude energy and food, which are the two areas we've been mostly concerned about. So if you're looking at it through the eyes of the Federal Reserve, they're going to call it transitory. 1/3 of the number was used cars. And yes, that probably is transitory as we are still in the throes of summer, big driving season, big vacation season, and people now, at least in the United States, are taking advantage of that, even with the high gas prices. But as far as going forward, it doesn't really correct what we have seen as the issues coming out of COVID, and this is without Asia really coming back fully. We have not seen real correction in the supply chain disruption or in the labor market, which is still low, or in the low production that we had by design in many of the raw material commodities. Now with demand increasing and supply not so great, that's still in play. And of course, good old Mother Nature, especially when it comes to food, considering we've got fires all over the place. We've had drought situations, and also even in some of the other growing regions besides the United States, like in Argentina and Brazil. So overall, everybody's looking at the yields and the rates, and today we've had a spike after these numbers, which was sort of expected. But nonetheless, you really have to ask yourself, at what point does the Fed really do anything, or was this just a knee-jerk reaction? Because they know if they do something, they're really going to impact the whole economy, which is still relatively fragile. Wage growth is definitely an inflation concern. Obviously, people who have been working for years, that has not met the cost of inflation. It's good for them, and you hope that their dollars turn into some kind of buying power. But at the same token, with the low labor force and all the perks that people or companies are giving, like, for example, McDonald's now really trying to hire people, all of these fast food places in particular that can't get the labor, the fact that they have to jack up not only their wages, but also their perks, definitely could mean something more inflationary down the road. And again, if it doesn't keep up with inflation, people are going to be going and reminding their bosses that, wait a minute, you gave me a 2% raise, but inflation's at 5%. I need more money. So yeah, none of this has really played out yet. This huge earnings that we had in right now, as we're seeing in the financials, and the expectation as we're going to get into the mega cap stocks, is again based on this whole notion of the fact that we came back much faster than what anybody anticipated we would. And so the banks have been sloshed with money. Of course, investors have been trading a lot, so there's a lot of money coming from there. And yet the reaction in the market after crazy earnings, and particularly if we just look at JP Morgan, they already were up 477% in their earnings in the first quarter, now meeting that again in the second quarter. People are looking ahead. Can that sustain? And I think everything we just talked about, yields and buying power and wage increase and economic fragility, is all why the market actually reacted in the reverse. The prices of JP Morgan fell after this incredible earning. And that may be a theme we see over the next couple of weeks. I've never been a big fan of hyperbole. As soon as you say that, you know, Jackie living in New York City, there's always the people in the subway who have the end is near. And of course, that kind of fear sells. People are attracted to hear about fear in the worst case scenario. And certainly, I think there's credibility to the fact of the growth. That's what I'm most worried about. We had an incredible 5 quarters of the S&P 500 gaining 5% for the last 5 quarters, which we have not seen since the 1950s. But think about the 1950s. This was the huge surge of the middle class when this country was really developing suburbia and industrial jobs and cars that were going full factory, or what do you call it, assembly lines. And so we don't have a situation like that. If anything, we have the opposite. The middle class has shrunk. Jobs are replaced with automation. So I certainly hear what Penya's saying, and I think there's a fair warning there. In terms of a total crash, I don't even want to think like that because it's too depressing. But nonetheless, Is it possible? Absolutely, it is possible. So we'll see what happens. But yeah, I'm telling people to be very careful. Well, China has such a completely different way of thinking about things. So a lot of the regulations that they're doing to keep some of these big companies from getting too much of a monopoly is smart, is something that the United States has been threatening to do with some of our big companies like Amazon and Google and Apple, Facebook, Microsoft, but hasn't been able to do anything, has been completely helpless in terms of really passing any kind of legislation. And the nature of China, they can do that more readily. And then that might not be the craziest idea, is to keep these huge companies like Baidu and JD and Alibaba from getting too strong through the regulation. So even though it hurts initially, it could actually be good in terms of bringing up smaller companies to be able to compete. So that's the difference between China and the US in terms of that one area. As far as looking at China in general, I think they've had some more issues with COVID, and they are lagging in terms of opening up again compared to the United States. I know as of last week, Singapore had to shut down again because of the variant. So if you take a look at that as transitory and the way that China is dealing with things in particular, I think that we could see actually the China market go up while the US market comes down, because that spread's been huge, where China has so underperformed the US. If you just look at the FXI, for example, which is the ETF for China versus SPY. Now, FXI looks like it may have bottomed. It's hanging tough. I think if you were long around 43.50, which is the price of FXI, which is trading 44.50 right now, and you basically kept that level in mind and didn't sit with it if it broke below and hung with it for a while, you might actually get some money that way. In terms of the Chinese stocks, I think you're going to see a lot of people afraid to buy them, but that doesn't necessarily mean that all of the bad news isn't priced in and they can go higher.